Hi, this is Dr. Rao working with you on another equity method investment exercise. So when we talk about the equity method, it means I have significant influence over the other company by way of owning their stock. So let's see what we have over here. Pfizer Pharmaceuticals paid $68 million on January 2nd, 2024 for 4 million shares of Corning Cosmetics common stock. The investment represents 25% interest in the net assets of Corning and gives us the ability to exercise significant influence over their operations. We received dividends of $1 per share on December 21st, 2024, and they reported, that's the Corning reported net income of $40 million for the year at the end of December 31st, 2024. At the end of the year, that's again December 31st, 2024, the market value of the shares is $18.50. We've also been told the book value of Corning's net assets is $192 million. Fair value of the depreciable assets exceeded book value by $32 million. They have a remaining average life of 8 years. Remainder of the excess of cost of investment over book value is attributable to goodwill. So lots of information given over here. They want us to prepare all the journal entries relating to this investment during 2024. Let's get started with the easy ones up front and then work our way down. So let's first start with, we made a purchase paying $68 million. So this journal entry is fairly easy. I acquired stocks in this other company, so I will debit the investment in equity account. I paid cash, so I credit cash. And what do I have over here? I purchased 4 million shares of the outstanding stocks, giving us 25% ownership in that other company. That number 25% is significant because I will use it in subsequent calculations. So that was $68 million. That number was given to me, so I can just put that here in the journal entry. The next journal entry is on December 21st, when I received $1 million per share. So in the equity method, when I receive the dividends, obviously cash is debit, that part is easy. To the extent that company paid out dividends, it drops the value of my investment because they are paying dividends from retained earnings, which is a part of owner's equity. If their owner's equity goes down, my investment goes down in value. So I credit the investment account, investment in affiliates, and how much did I get? I have 4 million shares and I got $1 per share. So it's 4 million shares, not the 25%, that already represents a 25%. So $4 million times $1 per share is what I got. And that is going to be $4 million. So for each share, we each got $1 and I got $4 million. On December 31st, they reported 40 million in net income. What happens to net income? It goes into retained earnings, which is a part of owner's equity. So when a company reports net income, retained earnings increase, which means owner's equity increase. So if where I have invested money, Corning's equity increases, my investment goes up. So I will debit the investment account, and now I will call it investment revenue. So when they report revenue, or when they report net income, I report revenue. Obviously, just my proportionate share. So I own 25% of the shares. So if they reported 40 million in net income, 25% of that is mine. So those numbers work out to $10 million, 25% of 40 million. So these three journal entries are fairly straightforward. This last journal entry is a little more involved, and let's see what that means. So to start with, how much did I pay? I paid $68 million. So let me write that number down over here. I paid $68 million. And what did I pay that for? I paid that for 25% of that company. So I paid $68 million because the fair value of the stocks was, if you take 68 million divided by 25%, it was 272 million. I purchased 25% of the stock, which is why I paid 68 million. So I'm working backwards to come up with this 272. So this is the fair value of the entire company on the day I bought it. Let's see over here. They're telling me that the book value of the net assets, so assets minus liabilities, that equity, the book value is only 192 million. So that is the book value on the day I purchased it. So 272 is the fair value. The book value is only 192, which means this company is undervalued by $80 million. Now they're telling us that the fair value of the depreciable assets exceeded the book value by 32 million. So of this 80 million, 32 million is the depreciable assets that are undervalued. The remainder is attributable to goodwill. So the remaining 48 million is attributable to goodwill. Now we didn't need to do all of this for the journal entry we need to do here, but it helps to understand what we are doing over here. The 32 million is depreciable assets. This one, what they've told us over here. It has a remaining life of 8 years, and we'll see why that number is significant as well. So basically what we are saying is, if the company had been valued properly, if the book value was the correct number to at the fair value, then we would be doing depreciation on a higher number. So we are under depreciating. So in our books, now we're not going back to that company and telling them what to do. But in my books, I'm saying what they're reporting as net income, remember that $40 million? We are saying that number is incorrect. They need to depreciate more, which means their net income will be less. If their net income is less, my revenue will be less. So I'm going to debit my investment revenue account, and I will credit the investment in equitable affiliate. Basically, this journal entry, I'm reversing it. And how much do I reverse it? That 32 million that it is undervalued, the depreciable assets, I need to divide that by 8 because I need to depreciate that over the remaining 8 years. But only 25% of that is my concern, not the remaining 75. That works out to $1 million. So 25% of 32 million is 8 million. 8 million divided by 8 years is $1 million each. So basically what I'm saying is that that company's assets in their books should be a higher number. If the assets are a higher number, their depreciation will be higher. If their depreciation is higher, their net income will be lower, which means my investment revenue will be lower. Land and goodwill, we don't do any adjustments because those assets are not depreciated. We leave it as it is. So it's only for identifiable depreciable assets that we need to make this adjustment. So once again, in this exercise, they've given us this information. So I didn't really need to worry about the 192 million and the goodwill. We don't need to worry about all of that. I just wanted to explain the whole information, all the information over here. This journal entry is done to mimic consolidation. That is something you will study extensively in advanced accounting. So this is just kind of trying to mimic consolidation, basically saying the company we bought, in their books, the assets are undervalued. If they value it up to what it should be, their depreciation will be higher. If their depreciation is higher, their revenues are lower, net income is lower, which means my investment revenue is going to decrease, and which is the adjustment we have done here. Now, one last thing, let's go back over here. This last sentence, the fair value of Kearney's common stock at December 31st, 2024 was 18.5 per share, $18.50 per share. That information is not relevant for me because I'm using the equity method. I have 25 to 50% investment. If I had less than 20% investment, then at the end of each year, I will look at the fair market value and do a fair market value adjustment. But for this This last sentence over here, the fair value of Corney's common stock at December 31st, that information is not relevant to our exercise. That's extra information given over here. So with this, we conclude our equity investments, and we will look at some exercises dealing with investment in bonds. That's the debt security.